Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of the guide to investing in high-quality tech stocks. This part goes deeper with practical strategies and examples to help build a strong tech portfolio. When you invest in high-quality tech stocks, keep your eyes on the horizon. These companies offer significant long-term growth potential. They are often at the forefront of innovation, developing products and services that shape the future. Think about artificial intelligence or cloud computing. These are massive, enduring trends. However, even the best tech stocks experience short-term volatility. Market sentiment can shift quickly. News, economic reports, or even a single earnings announcement can cause price swings. Don't let daily fluctuations distract you from the bigger picture. Focus on the company's underlying business strength and its ability to grow over many years, not just months. How do you stay calm when the market gets choppy? Remind yourself of the reasons you invested in these companies in the first place: their strong foundations and future prospects. Valuation metrics and considerations. Understanding a company's valuation helps you determine if a stock is a good buy at its current price. Several metrics can guide you. Price to earnings, P/E ratio. This compares a company's share price to its per-share earnings. A high P/E might suggest investors expect strong future growth. PEG ratio, P/E to growth. This refines the P/E by factoring in expected earnings growth. It helps you see if a stock's P/E is justified by its growth rate. Enterprise value to EBITDA, EV/EBITDA. This looks at a company's total value, debt included, relative to its earnings before interest, taxes, depreciation, and amortization. It's often used for companies with varying debt levels. Free cash flow yield. This shows how much cash a company generates relative to its market value. Strong free cash flow often indicates a healthy business. It is important to remember that traditional metrics might not fully capture the value of highly innovative growth companies. Their value often lies in future growth prospects and market disruption rather than just current earnings. For example, a company investing heavily in R&D might have lower current earnings but poised for massive future gains. Look beyond just the numbers. Understand the narrative and potential. Diversification within tech and across sectors. Even with high-quality tech stocks, putting all your eggs in one basket is risky. Diversification is key to managing risk effectively. Consider these approaches. Within tech, spread your investments across different tech subsectors. For instance, rather than only software companies, include hardware, semiconductors, or cybersecurity firms. This way, if one area faces headwinds, your entire portfolio isn't hit hard. Across other sectors, diversify outside of tech altogether. Adding stocks from healthcare, consumer staples, or utilities can balance your portfolio. Different sectors tend to perform well at different times. This diversification protects your investments from downturns specific to the tech market. It smooths out your overall portfolio performance. Monitoring industry trends and competitive landscape. The tech world moves fast. Staying informed is not just a hobby, it is a necessity for smart investing. Monitoring industry trends helps you anticipate shifts and potential impacts on your investments. Keep an eye on technological advancements. New technologies can create new markets or disrupt existing ones. For example, the rise of AI is transforming many industries. Emerging competitors. Small startups can grow into major threats. Keep track of companies gaining traction in niche areas. Regulatory changes. Government regulations can deeply affect tech companies, from data privacy laws to antitrust investigations. Understanding the competitive landscape also helps. Who are the main players? What are their strengths and weaknesses? How are they innovating? A company's ability to maintain its competitive edge is crucial for its long-term success. By staying informed, you can make timely decisions and adjust your investment strategy as needed. Risks and challenges in tech investing. Investing in high-quality tech stocks definitely offers exciting opportunities. Yet, even the biggest and best companies face their share of risks. It's smart to know what challenges these firms, and by extension, your investments, might encounter. Let's look at some of these potential hurdles. Regulatory scrutiny and antitrust concerns. Large tech companies often draw a lot of attention, and sometimes that attention comes from governments. Regulatory scrutiny is a growing concern. Governments worldwide are examining how these companies operate, especially regarding their market power and data practices. Why does this matter to investors? New regulations could impact a company's business model or restrict its growth. Antitrust concerns are also a big deal. Governments might try to break up large tech companies or limit their ability to acquire smaller competitors. This could change the competitive landscape and affect profitability. Think about how these rules could reshape even the most dominant tech players. Intense competition and disruption. Even market leaders aren't safe from competition. The tech world moves incredibly fast. Intense competition means even established giants face constant threats. New startup companies can appear quickly with innovative ideas. They might disrupt entire industries with a new product or service. Technologies also evolve rapidly. What's cutting edge today could be outdated tomorrow. Companies must invest heavily in research and development to stay ahead. If they fall behind, their market position can erode quickly. This constant pressure to innovate keeps high-quality tech companies on their toes. It also means investors need to monitor the competitive landscape closely. Economic downturns and market corrections. No company, no matter how strong, is entirely immune to broader economic conditions. Economic downturns can hit even high-quality tech stocks. When the economy slows, consumer spending might decrease. Businesses might cut back on their software or hardware purchases. This can lead to lower revenue and profits for tech companies. Market corrections are also possible. This is when the overall stock market experiences a significant, but temporary, decline. During these times, even fundamentally strong companies can see their stock prices drop. It's a natural part of market cycles. While these dips can be unsettling, they often present opportunities for long-term investors to buy into solid companies at a lower price. How will you react when the market takes a dip? High-quality tech stocks like Apple, Microsoft, and Nvidia offer strong potential for long-term growth. They stand out due to robust financial health, clear competitive advantages, and a commitment to innovation. These companies are guided by strong leadership and consistently adapt to market changes. Investing in them still requires careful research, a focus on the long haul, and an understanding of underlying business strength. While risks like regulation and competition exist, a diversified approach helps manage them. Keep an eye on market trends and company fundamentals for informed decisions. I hope you enjoyed this video. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.